as you know, I've always said, look, gold doesn't go up with inflation. That's propaganda. It peaked at 875 in 1980, went down for 19 years. All right. And U.S. national debt went up, inflation went up. It has been going up because of geopolitical. All right. That's when gold goes up. It went from $400 in December 79 to 875 in the last 6 weeks. Why? Because that's when Russia invaded Afghanistan. So it's always geopolitical. Yes, we advise a lot of the institutions in Europe. We're told like they're moving the gold to the United States. Why?
23,000. I put that number out there, and it's probably 27,000. Let me tell you where the number comes from, and it is rigorous. It's not a forecast. It's a conditional result as follows. If the United States wanted to go to a gold standard, and I'm not forecasting that, I don't think that's going to happen, but if the United States is going to go to a gold standard, what would the price of gold have to be to avoid a deflationary collapse?
Okay.
Quick favor before we jump in. If this video helps you in any way, please leave a like and share it with a friend. Those small actions tell YouTube that people are enjoying the video, which helps it reach more viewers. Could gold be heading toward a dramatic revaluation? Growing geopolitical tensions and renewed debate about a potential gold standard are fueling interest across financial markets. Martin Armstrong argues that gold's biggest price moves are driven less by inflation and more by geopolitical uncertainty. He points to historical examples, including the sharp rally that followed Russia's invasion of Afghanistan in 1979, to show how global conflicts can rapidly increase demand for safe haven assets. Armstrong maintains that inflation alone does not explain gold's long-term performance, noting that the metal experienced prolonged declines even as debt and consumer prices continued to rise. Jim Rickards focuses on the mechanics of a hypothetical return to a gold-backed monetary system. He explains that if the United States were ever to adopt a gold standard without triggering a deflationary collapse, the gold price would need to be substantially higher than current levels. Together, these views highlight the role of precious metals in a changing global financial order. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
If you look at the capitalization of just the New York Stock Exchange alone, forget NASDAQ and all the rest of them, all right? Just New York is more than all the capitalization of Europe combined. Home Depot, when it did an IPO, was more than the value of all the IPOs of Europe for 10 years.
Wow.
Europe is not a place that you can park money. And because they never consolidated the debt, as a major fund manager, I can pick up the phone and say, buy me 10 billion of U.S. treasuries. All right. I can't do that with Europe. All right. I still have to make the same decision. Do I want Germany? Do I want France? Do I want Italy? You still have, you didn't change the situation. You just moved the volatility from the currency market to the bond market. That's all you did. You know, it's just smoke and mirrors. So the problem with Europe is if you look back at 2010 when basically you had Greece get into trouble and needed an IMF loan. The traders, they were short, they made a lot of money, and they said, who's next? Oh, Spain, and run over to Spain and France, etc. So this is the problem because they didn't consolidate the debt. One EU gets in trouble and it turns into a contagion. And I suggest you can read online Herbert Hoover's memoirs from 1931, when you had all the sovereign defaults of Europe, all defaulted then. And he said capital acted like a loose cannon on the deck of a ship in the middle of a torrent. We're shooting off in every which direction so fast, we couldn't form a committee quick enough to figure out where it was going next. That's what he's describing is what I saw with Greece. And that's what will happen again with just one EU country in trouble. Plus also, yes, we advise a lot of the institutions in Europe. We told like they're moving the gold to the United States. Why? All you have to do is look at World War I. When that started, what did they do? They shut down all the stock exchanges, so you couldn't sell anything to get any money out. All right. And you just had Spain issue an edict that you could not take more than $3,000 in cash out of or 3,000 euros out of your account without government permission. Little by little, they're moving in this direction. And the CBDCs, they are planning to cancel the currency in Europe, as they usually do anyhow. And once they do that and they put it into a CBDC, that's 100% control. You can't get any money out. So that's why you're starting to see it move now.
Yeah.
Yeah, you can't take more than 3,000 out without permission from the government. And plus, on top of that, you've had Ursula come out and said that they're looking at taking money from private accounts to fund the war. And she called it unused assets. Well, yeah, look, you had Trudeau do that to truckers.
Truckers, yeah.
All right, but, freezing it. She's actually said taking the money as unused assets. That's what really created the German hyperinflation, not printing money. All right, what happened was they couldn't make the reparation payments, and in December 1922, and you can buy these bonds on eBay, all right, they took 10% of your account, handed you a bond, which they eventually defaulted on anyhow. That once they did that to people, they took the rest of their money and got the hell out of Germany. Right. So this is why when Hitler came to power in 1933, he made it a law that it was illegal to have an account outside of Germany without government permission. So he's trying to get that money back into the country. All right. That led to Switzerland in 1934, a few months later, created the numbered account to protect the Germans. Yeah. All right. And this is what she's talking about again. I mean, we've been warning our clients over there, look, you better have, get something the heck out of there, because once that first bullet is fired, she's shutting everything down. You won't be able to sell stock. You won't be able to do anything. So North Americans, I would not have any investments in Europe whatsoever at this stage. As you know, I've always said, look, gold doesn't go up with inflation. That's propaganda. It peaked at 875 in 1980, went down for 19 years. All right. And U.S. national debt went up. Inflation went up. It has been going up because of geopolitical. All right. That's when gold goes up. It went from $400 in December 79 to $875 in the last 6 weeks. Why? Because that's when Russia invaded Afghanistan. So it's always geopolitical. And, the EU once they've been using Ukraine basically as cannon fodder. They don't care. I was just dealing with Romania and most, why, supposedly the, pro-EU guy just won by a hair. All right. The vast majority of people, they understand. They do not want to go to war with Russia. All right. The EU does not care if one Ukrainian is still standing at the end of the day. They had a peace deal. Boris Johnson hopped on the plane, went over there and said, no, you're not allowed to sign.
Global capital flows toward markets that offer scale, liquidity, stability, and investor confidence when financial stress arises. Money often moves quickly from uncertainty into stronger financial systems capable of absorbing large amounts of capital. History has repeatedly shown how sovereign debt problems can spread beyond national borders, creating wider economic consequences for governments, banks, businesses, and investors. The European debt crisis demonstrated how concerns in a single country can trigger broader fears across interconnected economies and financial institutions. These dynamics show how market structure shapes capital allocation, financial resilience, and long-term strategy under pressure. Let's get back to the interview.
Okay, number one reason is central bank buying. Now, that inflection point was 2010. But from 1970 to 2010, central banks were net sellers. 2010 was the year when they became net buyers. Now, not the same central banks. Russia and China are buying, and before, Switzerland and UK. That's what we had from the mid-'80s to around 2000, and that was a long bear market for gold. It went down, and then it kind of just was flat. It was boring, actually. But we had very good economic growth, and that's why, I say to the White House, Trump's banging the table, get rid of Powell, lower interest rates, lower interest rates. Be careful what you wish for. Low interest rates are associated with recession and depression. A healthy economy, interest rates should be 5-6%, because that means people are like, hey, I can borrow at 5, make 10, leverage it, get 20% returns. That's what a healthy economy looks like. It doesn't look like 1% interest rates. That 1% interest rates looks like the Great Depression. Well, then we get into Steve Moran being on the board of governors. That's another whole thing. But lowering interest rates is, conventional wisdom is that's good for gold. Probably is, but gold went up 75% in the Great Depression, from $20 an ounce to $35 an ounce. So it was one of the best performing assets. Homestake mining was the best performing stock on the New York Stock Exchange from 1929 to 1933. And now the Dow fell 83%. But homestake mining was doing very well. It was a gold proxy. And the point I make is that the BRICS are not coming up with a new currency because they already have one. It's gold. In other words, so you're China, I'm Russia, so I'm buying manufactured goods from you, and I'm paying you in rubles, and you're buying natural resources from me, and you're paying me in yuan, and both central banks have got a lot of rubles and yuan. Those central banks can take care of their local buyers and sellers in the local currency, but then the central banks build this up in the reserve position. How much Chinese food do you need? I don't know, but you got a lot of yuan piling up. But a couple things about that. First of all, the BRICS are now I think 12 or 13 countries, and they have a waiting list of 20 more. So that trading area, if you think of it like the European trading area, is getting larger. These foreign currency balances are getting bigger. They still trade in dollars, by the way. I mean, the U.S. is trying to shut it down. That hasn't happened. Russia's getting plenty of dollars. But that aside, these local currency balances are building up. But a couple of things. Number one, you have to think about it on a net basis, not a gross basis. You don't have to settle on gross. If I owe you some yuan, you owe me some rubles, we net them out. One owes the other something, but it's a lot smaller than the gross, number one. And we can settle in gold. We don't have to use dollars. And now gold has a dollar equivalent. So you might end up converting everything to dollars for purposes of determining how much gold I have to deliver to you right now. It's kind of like Bitcoin. I was like, Bitcoin, end of the dollar. I was like, how come you keep talking about it in dollars? But the point is, the BRICS can settle on net. They don't have to settle real time. It can be 4 times a year. They can settle in gold. Everyone will take gold, and you don't even have to move it around. You have a central depository, but you can fly it around. It's not difficult. But the point is, so they're not coming up with a new currency. They have it in gold. So that, first of all, pulls the rug out from under the dump the dollar narrative. But secondly, it also supports the fundamental reasons why gold is going up. We did this war game in 2009. I mean, Secretary Gates looked at it. He said he did a nice job, but it was the first financial war game. But the scenario, which I devised as a member of the Chinese team, and I got an ally on the Russian team, and we were going to say, we're going to have a UK bank of issue and a Swiss depository, and everybody has to, if you send in your gold, we'll give you this new currency that we've just created, and the condition is from now on, if you want to buy Chinese goods or Russian natural resources, you got to pay in this currency. Now, the whole idea of a war game is look 5-10 years ahead. It's not like this is going to happen tomorrow. We got laughed at. There were some Harvard professors, and I won't mention any names, like, what are you talking about? You're wasting our time and all this. Since we did that, At the time, Russia's gold reserves were 600 tons. Today, they're about 2,500 metric tons. China's gold reserves were 600 tons. They're very close to 3,000 metric tons.
Wow.
So it has played out exactly the way we described it to the Pentagon at the time. I talked to their futurist, Andy Marshall, who he was like 90 at the time I met with him. But just unlike Biden, sharp as a tack, very, very astute. He was more of a listener than a talker. And I said, I called Mr. Marshall because I figured he'd been there since Nixon. I said, Mr. Marshall, there'll come a time when you're going to have a forward deployed military. You pull up at a dock in Singapore, and you're going to have to pay for your fuel in a currency that you don't print. And he said, he kind of shook his head and said, yeah, I got that. So the BRICS aren't there, but gold is. So the BRICS are using gold to settle net balances, not in real time, periodically. It works fine. So they already have their currency. 23,000, I put that number out there, and it's probably 27,000. Let me tell you where the number comes from, and it is rigorous. It's not a forecast. It's a conditional result as follows. If the United States wanted to go to a gold standard, and I'm not forecasting that, I don't think that's going to happen, but if the United States is going to go to a gold standard, what would the price of gold have to be to avoid a deflationary collapse?
Ah, okay.
And so, again, simple math. So when we had a gold standard, so the Austrians bang the table. It's got to be 100% back gold, or else whatever, it's leveraged. The truth is, the British maintained a very good gold standard, very powerful in the 19th century. They had about 20% gold. Up until the 1960s, the U.S. maintained a gold standard with 40% gold. Now, 40% gold compared to money, how do you define money? So you've got a M0, M1, M2. I mean, the Fed can't define money. They got like 5 flavors. So I use M1 because I think it's practical. So if you took M1 and you said, I'm going to back it with 40% gold, and here's how much gold I have, which is 8,133 tons, what would the price of gold have to be to equate to 40% of M1? And the answer is $27,000. So that's not a forecast, but it's a way to think about what gold is really worth in a world where people are losing confidence in the dollar. And you do have to go to a gold standard or something, some kind of peg. That's the lowest price, and that price keeps going up because M1 keeps going up.
The trends discussed today are not isolated events. They are part of a larger shift across the global financial system, from central bank actions to changing trade dynamics and growing demand for tangible stores of value. The signals point to a world that looks very different from the one investors have known for decades. Periods of transition often create both uncertainty and opportunity. Those who focus only on short-term headlines can miss the bigger picture, while those who understand the underlying forces driving markets are often better positioned to navigate what comes next. That's why developments surrounding gold, monetary policy, and global economic realignment deserve close attention. We'll continue tracking these major developments and breaking down what they mean for investors, markets, and the global economy so you can stay ahead of the curve. If you enjoyed this analysis, make sure to like the video, subscribe to the channel, and enable notifications. Your support helps us bring you deeper insights, expert perspectives, and timely updates on the stories shaping the future of finance.